German financial observers had tracked the American economy for decades. They studied Wall Street cycles, measured industrial capacity, reviewed Federal Reserve policy, and analyzed U.S. banking legislation with the same academic rigor they applied to European markets. Their consensus, shared across nearly every European finance ministry, was simple. America was rich, but immature. A country of entrepreneurs rather than economists. A place where booms were built on optimism, not discipline. A nation with vast resources, but a reckless attitude toward credit, consumer debt, and monetary policy. What they did not realize, what no European banker fully understood, was that the United States was quietly constructing an economic machine of a fundamentally different type. And when the moment of truth arrived, it did not come gradually, but suddenly. On the day German bankers discovered that the American economy was built on principles so alien to European thinking that their assumptions, calculations, and models collapsed in an instant. In the banking houses of Frankfurt and Berlin, a particular view of the world economy held sway. It was a view built on centuries of European financial tradition, on the hard lessons of hyperinflation and monetary collapse, on the belief that economic strength derived from discipline rather than expansion. German bankers did not simply manage money, they guarded it. They treated capital as a finite resource to be allocated with precision, protected from speculation, and deployed only when returns could be calculated with mathematical certainty. This was not mere conservatism, it was philosophy. German banking institutions operated on principles inherited from the merchant houses of the Hanseatic League, refined through the industrialization of the Ruhr Valley, and codified in the regulatory frameworks of the Reichsbank. Credit was extended carefully. Loans required collateral. Interest rates reflected risk in exact proportion. The entire system was designed to prevent excess, to ensure stability, to maintain the value of currency through restraint. When German financial analysts examined the American economy, they saw something that confirmed all their suspicions about the Anglo-Saxon approach to finance. Americans borrowed constantly. Consumer credit permeated every level of society. Department stores offered installment plans. Automobile manufacturers financed purchases directly. Banks competed to extend loans to businesses that had existed for less than a decade. The stock market traded at valuations that bore no rational relationship to assets or earnings. From the German perspective, this was not economic vitality. It was systemic recklessness waiting for its inevitable correction. The reports that crossed the desks of German finance ministries painted a consistent picture. American industrial production was impressive, but erratic. Corporate structures were chaotic, with new companies forming and dissolving at rates that made long-term analysis nearly impossible. The Federal Reserve, established only in 1913, was viewed as an experiment rather than a serious central banking institution. Its willingness to expand the money supply, to adjust interest rates in response to economic cycles, to intervene in credit markets, all of this struck German observers as proof that Americans had not learned the fundamental lessons of monetary discipline. European bankers believed they understood the American economy's place in the global order. America was rich in resources. Its agricultural output was staggering. Its population was large and growing. Its industrial base was expanding. But these were advantages of geography and circumstance, not evidence of superior economic design. Germany had built an industrial empire through careful planning, through the integration of banking and manufacturing, through state coordination of economic development. The German model had produced Krupp, Siemens, IG Farben, industrial giants built on decades of accumulated capital and technical expertise. America, by contrast, seemed to rebuild itself every generation. Its entrepreneurs launched ventures with borrowed money. Its workers changed jobs with frequency that European labor markets would never tolerate. Its financial markets treated speculation as legitimate business. German analysts noted these characteristics in their reports, often with barely concealed disdain. This was not how serious economies operated. The assumption that unified European financial thinking was straightforward. American economic growth was real but unsustainable. It was built on credit expansion that would eventually require contraction. It was driven by consumer spending that encouraged debt rather than savings. It was financed through stock market valuations that would inevitably correct. And when that correction came, the American economy would experience the kind of crisis that discipline prevents, the kind of crisis that mature economies, governed by experienced bankers, knew how to avoid. The first reports that troubled German financial observers emerged not from Wall Street, but from American industrial heartlands. In the early 1920s, as Europe struggled to rebuild from the Great War, American manufacturing output began registering numbers that didn't align with European economic models. German analysts received data showing that American steel production had not just recovered from wartime levels, but was accelerating beyond them. American automobile manufacturers were producing vehicles at rates that seemed to violate basic assumptions about manufacturing capacity. These initial reports were treated with skepticism. German banking institutions had sophisticated intelligence networks. They maintained relationships with correspondent banks in New York. They received regular reports from German commercial attachés stationed in American cities. And the data they collected seemed inconsistent with their understanding of how industrial economies scaled. The numbers suggested that American factories were achieving output levels that should have required decades of capital accumulation and infrastructure development. German steel industry analysts were particularly troubled. The integrated steel mills of the Ruhr Valley represented the pinnacle of industrial organization, vertically integrated operations that controlled every stage of production, from ore extraction to finished products. These facilities had been built over generations, with careful attention to efficiency and quality. Yet American steel companies, many of them less than 30 years old, were reporting production figures that rivaled Germany's entire national output. The analysts double-checked their data. They questioned whether American reporting standards inflated the numbers. They looked for evidence of statistical manipulation. What they found instead were procurement orders. American companies were purchasing industrial machinery at scales that confirmed the production data. Railway freight statistics showed raw material movements consistent with the reported output. Trade publications detailed factory expansions, new mill constructions, and capacity upgrades that suggested the growth was not only real, but accelerating. German observers began to realize they were not looking at exaggerated figures. They were looking at an industrial expansion that operated on different principles than European development. The automobile industry presented an even more confusing picture. German automotive engineering was world-class. Companies like Daimler and Mercedes-Benz produced vehicles that represented the height of mechanical sophistication. But they produced them in limited quantities for customers who could afford premium pricing. The American approach seemed almost deliberately inefficient. Standardized designs, limited customization, mass production techniques that sacrificed craftsmanship for volume. Yet the financial results were undeniable. Ford Motor Company alone was producing more vehicles annually than all European manufacturers combined, and doing so profitably. German banking analysts struggled to reconcile this with their understanding of consumer markets. The European model assumed that quality goods required skilled labor, careful production, and higher prices that reflected true costs. Americans were selling automobiles at price points that barely seemed to cover materials, yet their profit margins were substantial. The explanation appeared to be volume, producing so many units that per-unit costs dropped below what European manufacturers believed was possible. But this created another puzzle. Who was buying all these vehicles? The answer suggested something fundamental about the American economy that didn't fit German assumptions. American workers were buying automobiles, not wealthy professionals, not business owners, but factory workers, clerks, and farmers. This implied wage levels that German industrialists found difficult to believe. It suggested a consumer market operating on a scale that had no European equivalent, and it hinted at an economic model where mass consumption drove production rather than production constraining consumption. Financial reports from American banks deepened the mystery. German analysts observed that American commercial banks were extending business credit at rates far exceeding what European banking regulations would permit. The loan-to-deposit ratios seemed dangerously high. The collateral requirements seemed loose. The willingness to finance new ventures, untested technologies, and speculative enterprises violated every principle of conservative banking. Yet American banks were reporting consistent profits, low default rates, and growing deposit bases. By the mid-1920s, German financial institutions were receiving intelligence that demanded explanation. American industrial output was growing at annual rates that should have triggered inflation, currency depreciation, or credit crises. None of these were occurring. Instead, the American economy was exhibiting something that European models suggested should be impossible: simultaneous expansion in production, consumption, and financial stability. The numbers didn't make sense, but they kept coming. The full scope of American industrial capacity revealed itself not through economic reports, but through direct observation by German industrial delegations visiting the United States in the mid-1920s. What they witnessed in American factories fundamentally challenged their assumptions about how industrial economies functioned. At the Ford River Rouge complex in Michigan, German engineers observed a manufacturing facility that redefined their understanding of production scale. The complex didn't just assemble automobiles, it transformed raw materials into finished vehicles within a single integrated operation spanning over 2 square miles. Iron ore arrived by ship, was processed into steel on site, and emerged as automobile components without ever leaving the facility. The complex maintained its own power generation, employed over 75,000 workers, and could produce a complete automobile every 49 seconds during peak operation. German observers had designed factories. They understood industrial processes, but nothing in their experience prepared them for the scale at which American manufacturing operated. The River Rouge facility alone had more production capacity than major German industrial cities. It consumed more electricity than Frankfurt. It processed more raw materials daily than many European factories handled monthly. And it was not unique. Similar facilities were being constructed across the American industrial heartland. The mathematics of this production capacity created problems for German economic analysis. If American factories could produce at these rates, and if the reported rates were sustained across multiple industries, then aggregate American industrial output was reaching levels that exceeded German projections by orders of magnitude. German analysts had assumed American production was growing. They had not understood that it was growing exponentially, following a trajectory that European models classified as unsustainable boom periods before inevitable correction. But the correction wasn't coming. American industrial expansion continued through the mid-1920s without triggering the resource constraints, labor shortages, or financial instability that should have limited growth. German economists rechecked their data. They questioned American statistical methods. They looked for evidence that the numbers were inflated, or that the growth was concentrated in narrow sectors that would eventually saturate. What they found instead was broad-based expansion across multiple industries simultaneously: steel, automobiles, electrical equipment, chemicals, machinery, and consumer goods, all scaling at rates that seem to violate economic gravity. The agricultural sector presented an equally troubling picture. American farms were adopting mechanization at speeds that European agricultural economists found incomprehensible. Tractor production was transforming American agriculture from a labor-intensive operation into an industrial process. Crop yields were increasing, while agricultural labor forces were shrinking. American farmers were producing food surpluses so large that the U.S. was simultaneously feeding its growing urban population and exporting agricultural products at volumes that undercut European producers in international markets. German banking institutions began conducting more systematic analysis of American economic fundamentals. What they discovered was an economy operating at scales that had no historical precedent. American steel production exceeded the combined output of Germany, France, and Britain. American coal mining surpassed all of Europe. American oil production provided more energy than the entire European coal industry. American electrical generation capacity was doubling every 7 years. American railway freight volumes moved more goods annually than all European railway systems combined. These were not marginal differences. They represented categorical distinctions in economic scale, and they created a disturbing realization among German financial observers. If these production figures were accurate, the American economy possessed industrial capacity that could, in theory, outproduce the entire European continent, not company by company or industry by industry, but in aggregate. The implications of this were difficult to process. The more German analysts studied the American economy, the more they recognized that they weren't looking at a more aggressive version of European capitalism. They were looking at a structurally different economic system built on assumptions that violated German financial orthodoxy at every level. Credit in the American economy functioned as fuel rather than restraint. German banking principles treated debt as a necessary evil, something to minimize, to secure with hard collateral, to extend only when repayment was nearly certain. American financial institutions treated credit as an economic accelerator. Consumer credit enabled purchases that generated demand, which justified production expansion, which employed workers who could then service more debt. It was circular, yes, but it was also self-reinforcing when the cycle spun correctly. German bankers had a term for this kind of system: Schulden spiral, a debt spiral. It was something they were trained to prevent. But American banks weren't preventing it. They were engineering it deliberately. Department stores offered installment plans not as a last resort, but as standard practice. Automobile manufacturers established financing divisions that were more profitable than vehicle production. Banks competed to extend mortgages, business loans, and personal credit at rates that expanded faster than economic output. From a German perspective, this should have led to inevitable collapse. From an American perspective, it was how economic growth was accelerated. The Federal Reserve's role in this system was particularly alien to German thinking. The Reichsbank operated as a guardian of currency stability, adjusting policy to prevent inflation and maintain the gold standard regardless of economic conditions. The Federal Reserve operated as an active economic manager, adjusting interest rates to influence business cycles, expanding credit during contractions, and treating price stability as one objective among several rather than an absolute mandate. This difference reflected divergent philosophies about central banking's purpose. German doctrine held that monetary authorities should prevent excesses before they developed, even if this meant constraining growth. American policy accepted that economic cycles would occur and positioned the central bank to mitigate their severity. Germans saw monetary expansion as dangerous temptation. Americans saw it as a tool to be calibrated. The Federal Reserve's willingness to lower rates during downturns to accept temporary inflation during growth periods, to prioritize employment alongside currency stability. All of this struck German bankers as abandoning the central bank's core responsibility. But the results were undeniable. The American economy demonstrated resilience that rigid monetary policy didn't explain. When sectors contracted, others expanded. When regional economies stumbled, national markets absorbed the shock. The system had built-in stabilizers that German models didn't account for. Automatic mechanisms where credit expansion during growth created buffers that supported activity during contractions. American corporate structure revealed another fundamental difference. German industrial giants like Krupp and Siemens had built empires through vertical integration, controlling every stage of production from raw materials to finished products. They were marvels of engineering and coordination, but they were also rigid. American corporations were building something more fluid. They standardized components, outsourced production, and coordinated through market mechanisms rather than hierarchical control. This created redundancy and apparent inefficiency, but it also created adaptability. When Ford needed more parts, dozens of independent suppliers could scale up simultaneously. When demand shifted, component manufacturers could pivot to different customers. The system looked chaotic compared to German industrial organization, but it was chaos that enabled rapid adjustment. German factories were optimized for efficiency at planned production levels. American manufacturing was optimized for flexibility across variable output rates. The consumer market itself functioned as an economic mechanism that had no European equivalent. German industry produced for relatively small domestic markets and relied heavily on exports. American industry produced primarily for domestic consumption, and that domestic market was both enormous and growing. More importantly, it was homogeneous in ways European markets weren't. An American manufacturer could design a product, tool, a factory, and sell into a market of over 100 million people who shared a language, currency, and transportation network. No European country had comparable scale. This meant American companies could achieve production volumes that European manufacturers couldn't match. A single successful product could justify factory investments that would be uneconomical in Germany. Mass production techniques that made no sense for European market sizes became rational business decisions in America. The economies of scale weren't just about efficiency, they were about having access to market depth that made scale possible in the first place. German analysts began to recognize that American economic advantages weren't primarily about natural resources, although those were significant. The advantages were structural. The American economy was designed, whether intentionally or through evolution, to scale without constraint. Credit markets expanded with economic growth rather than limiting it. The Federal Reserve managed cycles rather than preventing them. Corporate structures adapted rather than optimized. Consumer markets absorbed production rather than constraining it. Every element reinforced expansion rather than stability. The moment of full comprehension came not during a boom, but during the crisis that followed. When the American stock market crashed in October 1929, German financial observers allowed themselves a moment of vindication. The American economy, they believed, was finally experiencing the correction their models had predicted. The credit expansion had reached its limit. The speculative excess was being purged. The American system was revealing its inherent instability. European banking practices, careful and conservative, would demonstrate their superiority. This satisfaction lasted approximately 18 months. By 1931, as the financial crisis deepened into the Great Depression, German analysts were witnessing something they hadn't anticipated. The American economy was collapsing, yes, but not in the way European models predicted. The failure mode itself was revealing capabilities that fundamentally changed German understanding of American economic power. The scale of American economic contraction provided the first shock. When German banks failed, they disappeared. When American banks failed, the system registered the failure and continued operating. Over 9,000 American banks collapsed between 1930 and 1933. And while this was catastrophic, the American banking system didn't disintegrate. Deposits shifted to surviving institutions. The Federal Reserve expanded liquidity. State banking regulators coordinated responses. The system buckled, but held structural integrity. German observers had expected American financial collapse to be total, a cascade where each failure triggered others, until the entire edifice crumbled. Instead, they were watching a failure that was severe, but contained. The American economy was so large, so diversified, so structurally redundant, that even a historic crisis couldn't destroy its fundamental capacity. Banks failed, but the banking function continued. Companies collapsed, but industries persisted. Employment plummeted, but the labor force remained capable. This was not how German economists understood systemic failure. When European economies collapsed, they required external intervention to restart. When the American economy contracted, it maintained enough internal structure to enable eventual recovery. The difference wasn't about better policy or superior management. It was about scale and design. The American economy was so vast that even catastrophic damage left enormous capacity intact. This realization crystallized when German financial observers analyzed American industrial production during the Depression. Output collapsed to roughly half of 1929 levels by 1933. But that meant American industrial production in the worst year of the Depression still exceeded Germany's peak output. America, in crisis, was producing more steel, more automobiles, more machinery, more chemicals than Germany operating at full capacity. The implications were staggering. The observation that truly shattered German assumptions came from analysis of American government economic intervention. When Roosevelt's administration began implementing New Deal programs, German observers initially dismissed them as desperate improvisation. But as the programs developed, a different picture emerged. The American government was intervening in the economy with scale and sophistication that revealed capabilities German analysts hadn't recognized. The federal government borrowed and spent at rates that should have triggered currency collapse. It didn't. The dollar remained stable because American financial markets could absorb debt issuance that would overwhelm European capital markets. The government reorganized banking regulations, created new financial institutions, and restructured agricultural markets. These weren't incremental reforms. They were systemic transformations, implemented in years rather than decades. The Tennessee Valley Authority provided a specific case study. The American government designed, financed, and constructed a regional electrical infrastructure project larger than anything comparable in Europe. It built dams, power plants, and transmission networks that transformed an entire region's economic capacity. It did this during a depression, using unemployed labor and borrowed capital, and completed it faster than European governments could have approved equivalent projects in stable economic conditions. By the mid-1930s, as German military rearmament accelerated, German financial institutions were conducting comprehensive assessments of American economic capacity. The question was no longer whether American economic power was real. The question was whether Germany, if conflict came, could prevail against an economy that, even in depression, exceeded European production capacity. The assessments were classified, but their conclusions were stark. If the American economy mobilized for war, if its dormant industrial capacity was activated, if its credit system was directed toward military production, if its government coordination capabilities were employed for sustained mobilization, it could outproduce Germany, Italy, and Japan combined. Not eventually, almost immediately, because the capacity already existed. It just needed to be pointed in a direction. German military economic analysts began systematic evaluation of American mobilization potential in the late 1930s. Their assignment was to determine whether the United States, if drawn into European conflict, could project sufficient industrial power to alter the strategic balance. The analysis required assessing not just current American military capacity, which was minimal, but latent industrial capacity that could be converted to war production. The results of this analysis were so disturbing that some German officials initially rejected them as methodologically flawed. The analysts rechecked their calculations, verified their data sources, and reached the same conclusion. If the American economy mobilized for sustained war production, it represented industrial capacity that no combination of European powers could match. The baseline numbers established the scope of the problem. American steel production in 1939 exceeded 50 million tons annually, more than Germany, Britain, France, and Italy combined. American aluminum production was 10 times Germany's output. American oil production was equal to the rest of the world combined. American electrical generation capacity exceeded all European nations together. These weren't projections or theoretical estimates. They were current production figures during peacetime, with significant idle capacity. American automobile production provided a particularly clear measure of manufacturing capability. The U.S. automotive industry produced over 4 million vehicles annually during the late 1930s. This required production lines, machine tools, skilled workers, supply chain coordination, and manufacturing expertise that could be readily converted to military vehicle production. German analysts calculated that American automotive capacity alone, if redirected to military production, could produce more tanks, trucks, and armored vehicles annually than Germany's entire manufacturing base. The aircraft industry presented similar mathematics. American commercial aircraft production in 1939 was modest, but the industrial infrastructure that produced civilian aircraft, the tooling, the assembly facilities, the engineering expertise, could be scaled to military production rates that would overwhelm German capacity. A single American aircraft manufacturer like Douglas or Boeing operated production facilities larger than Germany's combined aircraft industry. And there were multiple manufacturers, each with substantial capacity. German naval analysts studying American shipbuilding capacity found numbers that seemed to defy logic. American shipyards had built the commercial fleet that made the United States the world's largest maritime economy. The shipbuilding infrastructure that produced merchant vessels could be converted to military construction at scales that would render German submarine warfare strategically irrelevant. American shipyards could, if mobilized, replace shipping losses faster than German submarines could sink them. Not theoretically, the capacity existed and had been demonstrated during the First World War. Perhaps most troubling was the assessment of American machine tool production. Machine tools, the machines that make other machines, represented the foundation of industrial capacity. American machine tool production exceeded all European manufacturers combined. This meant that American industry could not only produce military equipment at unprecedented scales, but could also expand production capacity faster than any potential adversary. The ability to produce machine tools at scale meant the ability to build factories that built weapons faster than those weapons could be destroyed in combat. German analysts conducting these assessments recognized what the mathematics implied. A fully mobilized American economy could sustain production rates that would make attrition warfare unwinnable for any adversary. Not because American military doctrine was superior, or American soldiers better trained, or American commanders more skilled. Because American industry could replace losses faster than any conceivable enemy could inflict them. One German analyst summarized the finding in a classified report. The American economy is not best understood as a larger version of European industrial capacity. It is better understood as an industrial capacity of a different type, one designed to operate at scales that make traditional strategic calculations obsolete. Conflict with a fully mobilized American economy would not be a war. It would be industrial attrition, where one side possesses effectively unlimited industrial capacity. The Japanese attack on Pearl Harbor in December 1941 initiated the test of every calculation German analysts had made about American mobilization potential. Over the following 4 years, the American economy would demonstrate production capacity that exceeded even the most aggressive German projections. By 1943, American industrial output surpassed the combined production of all Axis powers. American shipyards were launching new vessels faster than German submarines could sink them. Not marginally faster, but at rates that rendered the Battle of the Atlantic strategically irrelevant. American aircraft production reached rates where the United States built more aircraft in single months than Germany produced annually at peak capacity. American automotive factories converted to tank production and manufactured armored vehicles at rates that equipped not just American forces, but supplied British, Soviet, and other Allied armies simultaneously. The Liberty ship program exemplified the industrial capacity German analysts had feared. American shipyards produced over 2,700 ocean-going cargo ships between 1941 and 1945, using standardized designs and mass production techniques. At peak production, American yards were launching multiple Liberty ships daily. Each ship required approximately 250,000 individual parts, coordinated from thousands of suppliers, assembled by workforces that had to be trained because experienced shipbuilders were insufficient in number. The program represented industrial coordination at scales that made German military-industrial planning look artisanal by comparison. German economic observers who survived the war and later analyzed American mobilization data found that reality had exceeded even their most pessimistic projections. American aircraft production from 1941-1945 totaled over 300,000 military aircraft. American tank production exceeded 88,000 armored vehicles. American artillery production topped 250,000 pieces. And critically, American industry achieved these production rates while simultaneously maintaining civilian economic activity at levels that ensured domestic political stability. The strategic implication that German military planners confronted too late was that war against American industrial capacity was unwinnable through any conventional military strategy. Tactical victories were meaningless against an opponent who could replace losses faster than battles could be fought. Territorial gains were temporary against an economy that could sustain unlimited logistical reach. Operational brilliance was nullified by material superiority that made attrition the dominant factor in every theater. The economic aftermath of the war confirmed what German financial observers had begun to realize in the 1930s. The American economy wasn't just larger than European economies, it was structurally different in ways that made direct comparison misleading. European economies emerged from the war damaged and depleted, requiring American financial assistance through the Marshall Plan to rebuild. The American economy emerged larger and more productive than it had entered, having expanded capacity during the war that remained available for peacetime production. The Bretton Woods Agreement in 1944 formalized American financial dominance in ways that would have seemed impossible to German bankers in the 1920s. The dollar became the global reserve currency, backed not by gold alone, but by the productive capacity of the American economy. The International Monetary Fund and World Bank became instruments through which American financial power could be projected globally without territorial conquest. The economic order that emerged from World War II wasn't a restoration of European financial dominance with America as a participant. It was an American-centered system where European economies operated as secondary powers. German economists conducting post-war analysis recognized what had been missed in the pre-war period. American economic development hadn't been reckless or undisciplined. It had been optimized for different objectives than European development. Where European economies prioritized stability, American development prioritized scale. Where European financial systems emphasized conservation, American finance emphasized expansion. Where European industry refined efficiency, American industry standardized for volume. Neither approach was inherently superior in abstract terms. But in the context of 20th century total warfare, where industrial capacity determined strategic outcomes, the American model had demonstrated overwhelming advantages. An economy designed for continuous expansion could mobilize faster and sustain higher production rates than economies designed for stable equilibrium. Financial systems built to manage risk through diversification and growth could absorb war costs that would bankrupt systems built on conservative lending. Industrial capacity, optimized for flexibility, could convert to military production faster than capacity optimized for efficiency. The final resignation among German financial observers wasn't that American economic power had prevailed in wartime. It was the recognition that the American economic model was not an aberration or a temporary advantage. It was a sustainable approach to organizing industrial economies that generated compound advantages over time. The longer the American system operated, the larger its advantages became, not because Europeans were economically incompetent, but because the American economy was solving a different problem at a different scale. One former German central banker, writing in the 1950s, captured the shift in understanding. We believed Americans were undisciplined because they embraced credit expansion. We considered dangerous. We believed their economy was unstable because it prioritized growth over equilibrium. We believed their financial system was reckless because it treated risk as manageable rather than something to avoid. We were not wrong that their approach carried risks our methods prevented. We were wrong that risk avoidance was the primary objective of economic organization. Americans built an economy designed to scale. We built economies designed to endure. In the 20th century, scale proved more decisive than endurance. The American economy had not won through better economic theory or superior financial expertise. It had won because it was designed to solve a different problem. And in the crucible of total war, that problem proved to be the one that mattered most.